The company being analyzed today is Frontier Springs Limited. This is a company which manufactures springs and some other components for the Indian Railways. So for the Indian Railways trains, they manufacture components. This is a very fast growing company. And today we're going to analyze the company's financials, what it actually does, and its future growth plans. So let us start. First, we have a market cap of 1,547 crore rupees. So it's a pretty small company, pretty small. The price to earnings ratio is around 30.4. The current price of one share is 3,900 rupees, 3,927 rupees. And the book value per share, book value is assets minus liabilities. So net asset value per share. Return equity and return capital employed, these are not the exact figures, but they are pretty good. We will take a look into it. Next comes the P&L of the company from 2014 all the way to 2025. Here we have sales, we have operating profit or EBITDA, we have the operating profit margin, we have the PBT, and finally we have the net profit or profit after tax. Very important component. So in 2014, the company reported sales of 37 crores and EBITDA of 4 crores. Okay. In 2019, the company reported sales of 83 crores, operating profit of 13 crores. Let's go a little forward. The COVID came, bad, bad year. Then the company took a turnaround. In 2023, 107 crores of sales and 13 crores of operating profit. You can see operating profit, it's black numbers. They have been consistent for quite some time, pretty same for quite some time. And finally, 2024, 135 crores of sales, 21 crores of operating profit, 16% operating profit margin, and 2025 was a blockbuster year of 231 crores in sales, 50 crores in operating profit, 22 crores in EBITDA, pure EBITDA, and 35 crores in profit after tax. Here you can see profit after tax had been consistent 7, 8, 8, 14, but again 8 quite some time. Last 2 years have been very good for the company. In terms of percentages, over a longer period of time, you can see 21% compounded sales growth for the last 10 years, 58% compounded profit growth for the last 10 years, and its stock has been rewarded. 62% growth in the price for the last 10 years compounded. All right. And one good thing about the company, these are the company's cash flows. Okay. The cash flows, pay attention to cash from operating activity. You can see it's mostly positive, like 6 crores in 2017, 9 crores in 2019, 11 crores in 2021, 10, 10, not increasing a lot. Like last 2 years, 22 crores, 2025, 2024, 12 crores, but at least it's positive and on the higher side in recent years. Now the question comes, what does the company actually do? So we will cover this. First, the business divisions. First is the Springs division. In 1991, the company shifted from leaf springs, we will cover what those mean to hot coiled springs for the Indian Railways, which has been our mainstay business for the past 30 years. The mainstay business for the past 30 years has been manufacturing hot coiled springs. All right. This is the springs division. Second division is their forging division, started in 2011, where they manufacture train parts such as anti-roll bar assembly, what is that, sorry couplings, craft gear assembly, and BSS hangers. So bunch of train parts. Last is the newer division, the air spring division. This is something new and big. This they started in 2022, and in 2025 the capacity was ramped up. We can actually, yeah, see, successful capacity ramp up. So this is a very recent business again for the Indian Railways. And what is this? They manufacture air spring suspension systems for LHB coaches for Indian Railways. LHB coaches are these like modern, comfortable coaches, like the seats on railways, seats coaches. So springs used for those coaches. So this is a new division. Okay. So let's see the products. The overall products are, first we covered air springs for LHB coaches, suspension coil springs for freight stock. So again, Indian Railways will have some trains to carry goods and service, sorry, goods, transport goods, that is freight. So coil springs for freight. Then suspension coil springs for coaching. So the people sitting, the coaches. So coils for people transportation as well as goods transportation. Two different segments are being catered, and LHB is this only. Then suspension coil springs for diesel and electrical locomotives. So again, Indian Railways. Then coil springs for the power sector. So they can even cater to the power sector. And forging components, these are train parts. So overall, from the products you can see, many of them are just catering to the Indian Railways, but they're able to cater to different needs of the Indian Railways. It can be coaching, all right, it can be for the freight, it can be power sector is different, it can be for diesel and the electrical rails, trains, and some of their parts, train parts. The company can cater to various diverse needs of the Indian Railways. Moving on, the marquee clients. Who are the main clients? We got Patiala Locomotive Works, Frontier Alloy Steels Limited, Banaras Locomotive Limited. We got Bhel, we got Texmaco. I think these are government enterprises, basically more PSUs and government enterprises. Then Indian Railways is their primary customer, and Indian Railways is the fourth largest railway network in the world. The revenues were 2.56 lakh crores in fiscal year 2025. I think so, 6.67 growth year on year. So big client, can be a pretty slow mover because it's so big and so penetrated in the market. But still, then remember the revenues of 230 crores of fiscal year 2025. The company's management has said that it's trying to achieve revenues, gross revenues. Now, the earlier 230 crores was net revenues. According to me, it's a difference of 20-30%. So, net revenues are like 20 to 30% lower than gross revenues, but they are trying to achieve gross revenues of 375 CR for fiscal year 2026 and 500 CR for fiscal year 2027. Maybe the 20% could be a bit much, but I guess I don't know the difference between the gross and the net revenues. How much of gross is actually converted into net? I think gross will include the discounts that they're actually adding. Net will minus all the discounts and all of that. But that's all speculation. They're just trying to they're trying to achieve in gross revenues. Gross is important. 375 CR. Then the next year, 500 CR in gross revenues. So at least in gross revenues, they're expecting some good growth. Financial highlights, the latest quarter. So in quarter two fiscal year 2026, they were able to achieve revenues of 82.74 crores, a EBITDA of 22.7 crores, 22.07 crores, EBITDA margin for high 26.68%, which the company thinks is pretty sustainable, this new operating profit margin. Profit after tax reached 15.71 crores in this quarter only. All right. And yeah, that's it. Yeah, these are the latest quarter numbers. Their 5 year performance. Now you can see in the 5 year performance from 2021 2023, despite revenues rising, EBITDA remained the same. EBITDA actually declined. Profit after tax also declined. It's the last 2 years where the company has seen both good revenue growth and great profit growth. See EBITDA margin, it was on a decline, 17% to 11.7%, then back to 21% in fiscal year 2025. Return capital employed took a hit to, not big of a hit, 11.5%, then increased to 35.33%. So return on capital employed is high for this year. Earnings per share, constant, bit of a decline. Last 2 years, big growth. So last 2 years again has been phenomenal for the company. And they're expecting good growth in the future, as we saw. Low gross revenues, but still. Now here we have the company's yes, balance sheet. We're going to take a quick look at the balance sheet. First, take a look at all these numbers in crores. So long-term borrowings are 3.05 crores. Short-term borrowings are 3.49 crores. But pay attention to this. Their cash and bank balances alone are 13.06 crores. So the cash and bank balances are more than the combined long-term plus short-term borrowings. So it seems on the surface, it's a very, very solid balance sheet. All right, cash alone is able to cover. And Indian Railways is, of course, a very reliable client. And for cash flows, it has been a pretty good. Now, in fiscal year 2025, we saw cash flows from operating activities 22.11 crores. But in H1 fiscal year 2026, H1 means quarter one plus quarter two combined, the company reported revenues of cash flows of 19.64 crores. So very good first two quarters of cash flows, already matching very close to their fiscal year 2025 cash flows. Let us see how will the next quarter be, next two quarters be for cash flows. Then, why invest in us? The company is saying, not me. Robust balance sheet, then the new Air Springs division to help improve the margin profile of the business. So it seems from this we can interpret that the Air Springs, the new business, is now higher margin. It's more profitable than the existing business. Then there are strong industry tailwinds and growth visibility in terms of Indian Railways, and new product is to significantly contribute to the top line growth. I think above the page is the industry tailwinds, the Indian railway growth opportunity. So, first of all, massive wagon orders. So, the Indian Railways, I think, place 72,000 wagon orders. It's a record placement with 50,000 more anticipated. So the government, so the Indian Railways is ordering more and more wagons. And the future procurement plans are around 90,000 wagons over 3 years, five times the annual average. And this is very important because for the wagons, the company Frontier Springs manufactures springs like coil springs, air suspension springs, plus the other train parts. Remember the forging business? So more wagons means more components they can manufacture. All right, so good for the business. So wagons is seeing record growth with even more growth, five times the annual average. Big. And freight and passenger capacity goals, 2.5 times increase freight by rail to 45% by 2030. Increasing freight by rail 2.5 times the overall capacity. Hold up. Okay, sorry. Increasing freight by rail to 45% by 2030 to 45%, and the passenger demand is forecasted to grow 2.5 times by 2051. Okay, all right, 2051. That's pretty far away. Even still, at least this is good. The wagons one is very nice. Finally, we're going to analyze the company's con call. This is a meeting where the shareholders of the company or investors in the company they meet with the company's management, and the management answers questions about the business and all of that. So we will take some questions and get some answers. Now, question was asked, can we expect a 27% 26 margin EBITDA margin as sustainable going forward? And the company answers, yes, at least for this year, I'm confident we will be doing this. Nice. So 26%, 27% EBITDA margin. Nice. Then they said that revenue was around 35 to 40 crores by Air Springs and around the same for coil springs, and the remaining is for forging division. Now, I don't know. I think it is for this quarter and like previous quarter. I think this is first half fiscal year 2026. Is it first half? I don't know. Is it a quarter or the last two quarters combined? But whatever. Basically, 35 to 40 crores air springs. Coil springs is again 35 40 crores. So they're pretty similar in revenues. All right. It's a new division. So pretty impressive. New division and still able to match the old division's revenues. And 16 to 17 CR is from forging division. Fine. Then we move forward to, hold up. Yes, this. Where is it? Yes, this is a good question. Question was asked, so one more point. How do you see the competitive landscape? Any new entrant in the market which may possibly hurt the growing state of frontier springs in the air springs and coil springs? Any new entrant in the market? So competitive landscape, how is it looking? Answer by management. With the existing competition, I don't say that nobody will come. There might be one or two people who might come into air spring or maybe in coil spring. but the roadmap to getting regular orders is for at least 2 years because railway has a system of getting approval, and then they give a few orders and then they run the component for 1 to 1.5 years. So it's a very tough road ahead for any new entrant. So tough road for any new entrant because in order to get regular orders from the customers for at least 2 years from Indian Railways, there's a system of getting approval, big system of getting approval. Okay, so for a new player, the roadmap getting regular orders is at least 2 years. Around 2 years it can take. So you set up a unit and then wait for 2 years for the regular orders. That is a big task. Okay, so it's tough for the like new entry players. Like you have to set up a manufacturing unit, then wait around at least 2 years, on average 2 years for regular orders to come in. Continuing, being an old supplier to Indian Railways and supplying so many components last almost 40 years, we have a different kind of thing. We have components which are running, like if I'm entering into FIBA. FIBA is a new component, so they're entering into another component. We have to go through the same process. Definitely a leverage for existing resources, and we can start developing with the small capacity, and then after the approval time comes, and after the testing period is over, we can immediately increase capacity. So it's a system in Indian Railways. For the new entrant, it is really, really tough task to set up a unit and wait for 2 years to get a regular order. So people may come, but it's a tough task. Okay, so people can come, new players can come, like 1 to 2 players can come. I think not a lot are expected by this statement at least. And it's tough. It's going to be tough for new players to get regular orders because they have to like wait around for 2 years. And they're entering into FIBA. The company is entering into other kind of component, FIBA. I don't know what the component is. I think finally, the final page, market share. What is the company's market share? So in terms of coil springs, they have a market share of almost 40% of Indian Railways demand. 40%, that's good. And the air spring division, you're already having almost the same share. So coil springs, air spring division both generate similar revenues and both have about 40% of Indian railway demand. The market share of 40% of Indian Railways demand, and forgings they have around 20 to 25% of Indian Railway via catering. 20-25% demand of Indian Railways they're catering to. So pretty good market share, yeah. 40%, 40%, and forgings 20 to 25%. So final summary, Frontier Springs has seen good growth, good growth. Maybe this return equity of okay, never mind. It has seen good growth at least for the past couple of years, with profit margins rising a lot. It is cash flow positive company and cash flow seem to be increasing. Taking a look at the longer trend, they seem to be increasing. The company seems to have a good share of the total demand of Indian Railways it is catering to, and it's entering into some new components. It's able to cater to a wide variety of Indian Railways demands. The competitive landscape seems pretty tough for new entrants. So maybe it won't have a lot of competition, but things can always change. That is it. Bye.